Right. Welcome to the session. Today also we are trying to just deal with some past paper questions, and I think this past paper question discussion is a very important one where you can just understand how the things can be applied. And what I feel is following the lecture would not help you so much, but if you can just uh, deal with these past papers, it is very much important for you to gather the knowledge, and you know how to apply the things there, and that will help you to answer the forthcoming question paper in a very successful manner. And on the other hand, what you need to do is when you follow the questions and answers, so you need to understand the way you can do it, and you try on your own. And after trying on your own, you will feel what type of problems you face. So if you come across any type of confusion or any issue, then you can clarify the things at the class. That is the way, the plan of your study program. What I feel is if all of you can do that, then the success is assured in that case. So we will go into another question paper today. Right. Today we are trying to just discuss the question paper given on 2017. Now, as usual, we can go into the question number 1, and that question consists of short answer questions, but there have to be explanations. Give your comments and relevant explanations regarding the following statements. You may illustrate your explanations through graphs and diagrams. Now, since it is mentioned here to illustrate your explanations, you need to do that, and you need to make use of graphs and diagrams in order to explain the particular concept. Now say part A. Capital market line is the efficient frontier for portfolios contain risk-free portfolio and equity portfolio in various ways. So that is the statement given. So then you have to give comments on this. First of all, when you deal with this type of question, first thing what you need to do is you need to tell whether this particular statement makes sense, or and if it is wrong, you have to mention that it is wrong. That is the first thing what you need to do. So therefore the answer begins with the statement is correct. That is the way you have to answer this, and then you have to explain how it comes. Capital market line is the efficient frontier for portfolios contain risk-free portfolio and equity portfolio in various ways. Now, when you have a portfolio with equities, so you can start the particular efficient frontier, showing that efficient frontier. First, what you need to do is you need to get the risk into the horizontal line, and to get the return into the vertical line. So that diagram you have to show in this part A of this question. You have to show that diagram. Now in the diagram, what you need to do is you need to have a graph on the paper and say that you can draw the horizontal line, and the horizontal line depicts the risk. The vertical line depicts the return. So the risk return characteristics we have to find out of the portfolios of equity portfolios. And first, what you do, you just plot the things on the graph, and you have to mark the efficient frontier. So that is the first thing what you need to do in a diagram. In a diagram, you need to do. So I will show you the diagram on the board. Right. Now you can just see the diagram. Now as per that diagram, the horizontal axis depicts the risk part of it. Vertical axis depicts the return part of it. So if you take equity portfolios, so you can plot the points together with portfolios, risk and return. So you have this type of plots. Then when you want to have the efficient frontier, so that is the topmost level points, you just add it, just connect and you get the efficient frontier. Now this is the first thing. But when you add risk-free assets into this portfolio, and for different weights, you will have another efficient frontier which starts from R here. R is the risk-free rate. And if you draw a line from this this point, and if it makes a tangent to this efficient frontier, so that would be the efficient frontier for portfolios mixing risky assets with risk-free assets. So that is the efficient frontier for that. So this is also known as capital market line. It is also known as capital market line. So that is the representation in a diagram. The concept even in part A. So if you just put these diagrams on the paper, you will get the full marks. Otherwise, you may not get the full marks. Oh, ටිකක් කලවර වැඩි වුණා වගේ. Right. I think the first part is answered in that manner. So the statement given is capital market line is the efficient frontier for portfolios contain risk-free portfolio and equity portfolio in various ways. So that is the statement, and I just shown you how it comes, how it can be demonstrated on a diagram. And as I told you earlier, you need to start with the statement is correct. So that is how the answer has to be given. So then you say capital market line is the efficient frontier for portfolios contain risk-free portfolio and equity portfolio in various ways. So earlier efficient frontier we got only through the risky assets. So that efficient frontier is the curved one. It is not the straight line. Then part B. The CAPM contains only efficient portfolios and securities. The CAPM is the capital asset pricing model, contains only efficient portfolios and securities. So first of all, you need to check whether it is correct or not. So just think about it. Right. So what do you think? The CAPM contains only efficient portfolios and securities. No, it is not the case. Therefore, the particular statement is false. So you have to start with the answering has to be started that the statement given in part B is wrong. It is not the case. You can't say the CAPM contains only efficient portfolios and securities, because CAPM deals with capital asset pricing model, deals with the return and the beta. So therefore, this statement is wrong. In a capital asset pricing model, straight line or the line. So how can it be constructed? So when you construct that capital asset pricing model line, what are the two axes you consider? The one axis is beta, that is x-axis, it is beta. Then y-axis is the return. So when you plot it and you get this curve CAPM, the line, so beta would be the independent variable, and expected risk or expected return is the dependent variable. So it doesn't talk only in terms of efficient frontiers and efficient portfolios and securities. So therefore, this statement is wrong. So you have to give that answer and you say it is wrong, and then you say, but how do you get capital asset pricing model or the line, CAPM line? So we call it SML sometimes, security market line. So that is being drawn by plotting the points at beta against ER or the return. Then part C. CAPM, now it is a line, CA capital asset pricing model. It is being denoted by a line, straight line. That straight line comes in a graph where the x-axis is beta, y-axis is expected return. So there this the statement which is saying that CAPM contains only efficient portfolios and securities, it is wrong. And when you make the answer, you have to say the statement is wrong and the CAPM or the security market line is drawn with the help of two axes of a graph. One axis is x-axis is the beta, y-axis is the expected return. So that is part B. Now, if you go to the part C, there are the statement is along the capital market line, leverage portfolios have more unsystematic risk than non-leverage portfolios. Now, then, first of all, you need to understand what do you mean by leverage portfolio and what do you mean by non-leverage portfolio. Now, in the capital market line, so I have already drawn that diagram. So there you can see now you see the board. Now you see the capital market line. Now in the capital market line, from this point, the capital market line divides into two parts. The part which is left to this particular point is called the non-leverage portfolios. If you get from this point to the right of it, these are the leverage portfolios. So that is how it comes. Now, when you have a leverage portfolio, now what it says, along the CML, leverage portfolios have more unsystematic risk than unleveraged portfolios. So, unsystematic risk they are talking about, but we are not in a position to see anything about unsystematic risk here. Actually, the systematic risk is increasing. That is what happens really, not the unsystematic risk. Here, the systematic risk we are talking about, because in the capital market line. So that is wrong. So therefore, the answer for the part C along the capital market line, leverage portfolios have more unsystematic risk than non-leveraged portfolios. So that statement is also wrong. That statement is also wrong. Now you see, there are the marks allocated is higher than the above two parts, because above two parts only allocated 6 marks each, but here you get 8 marks. So that means it is a more complicated type of a question. Along the capital market line, leverage portfolios have more unsystematic risk than non-leverage portfolios. So there's no such thing, because we are not talking about the unsystematic risk here. We have taken only the systematic risk, basically. Right, with all that, we will try to get the question number 2. Now here the main difference here, the question number 2, it doesn't involve any probabilities. The following schedule depicts the historical return of Eagle and Helix companies. Now the returns were given from 2012 to 2016 for 5 years. 20% Eagle in 2012, minus 10% in 2013, 15% in 2014, 17% in 2015, and 19% in 2016. Helix, 2012 30%, 2013 minus 20%, 2014 18%, 15 10%, and 16 5%. Determine the covariance of returns between Eagle and Helix companies. Now, first of all, we need to calculate the covariance. Now, in order to calculate the covariance, first of all, we need to get the average or mean value of these returns. So, how do you get the mean value of the returns? So, we are referring not to the geometric mean return, but here you have to get the normal return, arithmetic return. So, first of all, we calculate the return for Eagle, average return for Eagle and average return for Helix. After calculating average return for Eagle and average return for Helix, we should get the particular value minus the average in another column for Eagle and Helix in another column. So later on, what we can do is we can multiply these two and add it up and divide by 5. So then you get the covariance between Eagle and Helix. I don't know whether you get this point correct. Yes. Now, unlike in other sums, here no probabilities are involved. So only the historical returns you got, and you got the returns for 5 years, and you have to get the covariance between Helix and the other company. And what you need to do is you need to first calculate the average return for Eagle and average return for Helix. So first of all, we do that, right? So shall we calculate the average return for yes. Right. Now your task is to calculate the mean value for Eagle. Eagle, what is the value for mean value? And what is the value for Helix? Yes. Yes, what is the mean value for Eagle and what is the mean value for Helix? Now, before doing the covariance calculations, you need to first get the mean value for Eagle and mean value for Helix. Now, when you want to get the mean value for eagle, what you need to do is you need to add up all the returns together. So you just forget about the percentages. You can say 20 plus 15 plus 17 plus 90 and minus 10. So what you do is you add 20 plus 15 is 35, 35 plus 17 is 52, 52 plus 19 is 71, 71 minus 10 is 61. 61 divided by what? 5. 61 divided by 5. That is 12.2. So the eagle's mean return is 12.2. Shall we do it again? 20 plus 15, 35, 35 plus 17, 52, 52 plus 19, 71. 71 minus 10 is 61. 61 divided by 5, that is 12.2. 12.2. For helix, it is 30 plus 18, 48, 48 plus 10, 58, 58 plus 5, 63, 63 minus 20 is 43, 43 divided by 5, that is 8.6. For eagle, it is 12.2, and helix, it is 8.6. Right. So when you calculate the mean of eagle and mean of helix, you get for eagle you get 12.2, for helix you get 8.6. Then what you do next? Then you have to deduct from each return the mean value. For helix also the same thing.
So the whiteboard is not clear, sir.
And
So whiteboard is not clear.
good. Now is it okay now?
No, sir, it's dark.
It is dark or
Yes.
oh, right. So the paper is uploaded here. Paper is uploaded. So anyway, I will just go into the paper again and I will put it on the screen. This is the paper. So I just started, I just completed the question number 1, and now I am in the question number 2. So under the question number 2, even though the board is not very clear, what you can do is, first of all, you need to calculate the mean value of eagle and mean value of helix. Very simple things. So you calculate that, and you need to get some values for that. Now you see the question paper, no? You got the question paper on the board? Yes, you are. Isiri has given the correct answer for covariance. That is correct. No, the particular paper I will put on the screen. I will put on the screen. Actually, I started with the question number 1, and I just gave some explanations on that also. But now I am in the question number 2. Paper එක හම්බුන්නේ නැහැ කියලා. You have ear column, and that is the first column. Then you have the eagle and helix columns. Sorry, helix and eagle columns. Helix comes first. So anyway, so there for helix, the average value is 12.2. For eagle, the average value is 8.6. Bold එක ආයේ මෙයා මොනවද කියලා. Bold එක ආයේ clear නැති වුණා. ලයිට් එක ඔෆ් කරාට දැන් පේනවා. Clear වුණා. නෑ මට ප්‍රශ්නයක් නෑ මට මේ මෙතන බලන්න. දැන් bold එක. නේ බලන්න. හරිද දැන්. ඔව් දැන් හොඳටම පේනවා. දැන් ගන්න ඕනේ. දැන් පේන්න ඕනේ ඒක තමයි. ඔක තමයි වෙන්න පුළුවන් විශේෂ. ඉස්සෙල්ලා දැන් මම
ප්‍රසන්ටේෂන් නැතුව තමයි සර් බෝඩ් එක යූස් කරන්න ඕනේ.
ඔව්.
එතකොට ක්ලියර්.
ඔව්. නෑ මේ මම දැන් ප්‍රසන්ට්
බෝඩ් එකේ ලියනකොට
ඔව්.
සර්ට බලා ගන්නත් ඕනේ හයි කොපියක් කියලා දෙන්නද?
නෑ නෑ තියෙනවා මගේ ළඟ තියෙනවා මේක තියෙන ප්‍රශ්නයක් නෑ මේ රයිට්
අය පේපරේ දානකොට ෂෙයා කරන්න ඕනේ.
නෑ ඒක හරි ඒක දැන් මම කරා කොහොමද
ඔව්.
නෑ මේමයි දැන් මෙතන නව බලන්න මේගොල්ලෝ කියනවා
මම උඩිනුත් චෙක් කරා සර් ඒක
හරියෙන් බලන්න
ඔව්.
right okay now you can just see the points here eagle helix then under eagle you have these values and the values we can put and we can get the mean value and the mean values and every mean value has to be deducted from respective returns. Then you have to multiply that. So the total comes 840, the multiplication 810.4 and that has to be divided by 4 and then you get the answer 162.08. So that is correct answer. The covariance is that. So then you need to calculate the standard deviation of returns of eagle and helix. There we do the calculation and see what are the standard deviations. Yeah, Eagle's standard deviation is 11.23 and Helix standard deviation is 16.61, correct. Now the next question is calculate the correlation coefficient between Eagle and Helix. Now you can just see the marks allocation. For the first part, the only 6 marks allocated. Then the second part also 6 marks allocated, and for the third part 8 marks allocated. Now you need to calculate the correlation coefficient. Now there's a formula for that. For correlation coefficient, it is calculated by dividing the covariance by 2 standard deviations. So that is covariance EH divided by sigma E into sigma H. So we have calculated covariance, that is 162.08. Rho is equal to rho EH is equal to covariance EH divided by sigma E into sigma H. That is 162.08 divided by 11.23 into 16.61. Now, have you got this correlation coefficient? .868. Yes. See, 0.8689, or if you put it into 3 decimals, it is 869. 0.869 is the correct answer. The correlation coefficient is 0.869. Right. Now, if you get another question here, but it is not in the paper, I can just show you that. Here there are only three parts. Calculate the correlation coefficient between Eagle and Helix return. So, but there can be another question here, whether the relationship between Eagle and Helix returns are significant. So that is another question which we can ask. So in that case, what would be the answer if that question is there? Or you have to see whether the relationship between Eagle and Helix, whether that relationship is significant. How do you see whether it is significant or not? If a correlation coefficient comes higher than 0.5%, we call it a significant relationship. Here, the correlation coefficient is 0.869. So therefore, invariably, the correlation is very, very significant. So we can say the relationship between Eagle and Helix is significant because the correlation coefficient is 0.869. So that is how the answer is to be given for this question. Only thing is now if you can just get the worksheet done, so there's no issue in calculating the answer. Only thing is now if you don't have an arranged way of calculating this, then you might face with severe problems. So then you make it a point to just plan your activities in the worksheet. So if you do that correctly, then your answers also you can get easily without a mistake. So we can go for question number 3. The Trust Computer Corporation has been experiencing an above normal dividend growth rate of 20% per year for the last 5 years. This above normal growth rate is expected to continue for another 5 years before it levels off at a more normal rate of 6%. Trust last dividend was 50 cents dollars, determine the current value of trust stock if its required rate of return is 15%. Now this is, if you look at it, so you will feel that the particular question is related to the two-stage model of dividends. Two-stage model, because you can see the rate of return as only 15%, whereas the growth rate of dividends is 20%. So therefore, if you apply it for the one-stage model, you will get a minus price there. So therefore, we can't use one-stage model to compute the stock value here. What we can do is, we can use the two-stage model to calculate the value. Right. Now, what are we going to do now? Now, they say after 5 years, the growth, dividend growth of 20% will go down to 6%. So then what we need to do is, we need to calculate the cash flows, dividend cash flows for the first 5 years, and it has to be discounted by the required rate of return. For example, the first year, end of first year, what you get is the current year's dividend is 50 cents, and 50 into 1 plus 0.2, or 50 into cents 50 into 1.2 will give you the year 1 end dividend. So likewise, you will see the dividends for year number 2, year number 3, and year number up to year number 5, and those to be discounted by the rate of return. So by doing that, you will be able to calculate the cash flows for the first 5 years. Now we are referring to the sum given on the Trust Computer Corporation, and their normal above normal dividend growth rate is 20%, and this rate from now onwards it will go another 5 years, and the normal rate of return would be rate of dividends would be 6% growth rate. So we can just look into that this way. Right. Now you can say dividend cash flows for the coming 5 years. So we can say 0.5 into 1.2 divided by 1.15 plus 0.5 into 1.2 squared divided by 1.15 squared plus 0.5 into 1.2 to the power 3 divided by 1.15 to the power 3 plus 0.5 into 1.2 to the power 4 divided by 1.15 to the power 4 plus 0.5 into 1.2 to the power 5 divided by 1.15 to the power. Now this is the dividend cash flows for the first 5 years. The present value of all the dividend cash flows. So you can just look at the board now. Now just check it. Now this, if you solve this, you will get the first 5-year dividend cash flows for this trust computer company. And we can calculate this, the value. when you prepare the workings, first of all, what you can do is you can get the dividend cash flows calculated for the first 5 years. The first year you will get the cash flow 0.5 into 1.2 divided by 1.15. Then you get 0.5 into 1.2 squared divided by 1.15 squared, plus then you get 0.5 into 1.2 to the power 3 divided by 1.15 to the power 3, plus 0.5 1.2 to the power 4 divided by 1.15 to the power 4, plus 0.5 1.2 to the power 5 divided by 1.15 to the power 5. So these are the future coming 5 years dividend cash flows and their present values. Then at the end of the 5th year, you assume that the particular stock is sold. And when it is sold, the price can be calculated by using the one stage model, where the growth rate become 6%. So then when you apply the particular formula, the formula comes with P is equal to D01 plus G divided by K minus G. So D0 here is the 5th year dividend amount, that is 0.5 into 1.2 to the power 5. And it has to be multiplied with 1 plus 0.06. And it is to be divided by K minus G. K is 0.15, G is 0.06. And since we get the price after 5 years, but we have to get the present value of that price, and that has to be divided by 1.15 to the power 5. So these are the workings for this calculation. Yes, if you do the workings, you will get this. So the 5 dividend cash flows in the coming 5 years come to 2.8456, and at the end of the 5th year, if you sell it at the price at which the dividend is the stock is sold comes to 7.82861. So the total of that would give you 10.13. That is the price of the stock. That is the price of the stock. Yes. So I just want you to do the calculations on your own. Otherwise, this may not be understood. So it is for your interest that you need to do it on your own. In the examination also, you need to do it on your own. So therefore, you just get the practice and get the the familiarity with these things. Right. Now we just had the discussion on question number 3 of the earlier paper. There you have the trust computer company listing and the dividend growth rate is 20% for the first 5 years, and later on the dividend growth rate will come down to 6%, and rate of return would be 15%, and you need to calculate the share price of that stock. So what I did was I just got the cash flows, dividend cash flows for the first 5 years. And then at the end of the 5th year, we calculated the price of the stock, and assuming that we sell the stock at that price, and we calculated the present value of that price. The total of the present value of cash flows and the present value of the price of the stock would give you the stock value. If anyone want to clarify that, what it is, so I can really explain it again if you want. Yes. This type of sum is a very frequent one where any examination it might come. So therefore you should get your familiarity with the sum like this. Yes, now you just see the workings here for the sum number 3. After this, after working out this sum, I will go to the other question paper. Now in that question, that is the question paper, I think that is with you, 2017-2018 question paper. Yeah, you have these question number 1. Determine whether the following statements are true or false and give a brief justification for your decisions. Now the nature of this question is to just straightforwardly say that whether it is true or false, and you need to justify your answer. That is the only thing here. And each part carries 5 marks, and that 5 marks will consist of the straightforward answer of true or false thing, or in addition to that, there should be a justification. If you don't give the justification, you get only a fraction of marks for that. Right. Part A. An underpriced asset will be above the arbitrage pricing line. Underpriced asset. Now, this one, when you say arbitrage pricing line, now arbitrage pricing line is the equilibrium line. An underpriced asset will be above the arbitrage pricing line. Now, first of all, you need to do whether you need to see whether it is a true statement or a false statement. What do you think about this? Now, normally the normal way is when you have a overpriced asset, the return comes from overpriced asset would be low. That is lower than the equilibrium return. And if you have an underpriced asset, what will happen is it has a return which is higher than the equilibrium return. So therefore, it is normally above the arbitrage pricing line. So therefore, the statement given here is correct. So then first of all, you have to say the statement given, the underpriced asset will be above the arbitrage pricing line is correct, is true. So the particular explanation will be, if you get an underpriced asset somewhere, invariably it will provide the higher return, which result in the higher return thing would be placed above the arbitrage pricing line. Arbitrage pricing line is the equilibrium line. So if it is higher than the equilibrium return, so therefore it is in the upper part of it. So therefore the statement is correct. That is the question number 1, part A, answer. Any issue? Any issue for that? Because if you don't engage in the discussion, then I don't think that you get a satisfactory type of input here. If you don't engage in the discussion, I don't think that you get a value addition here. So therefore, I request all of you to involve with the lesson. If you don't involve, then there will be there won't be any type of value addition here. So the sum which we have already worked out, now I don't know whether you have just gone through the question number 3. Now, what we did was we went through the question number 3 with regard to Trust Computer Corporation. So our attention has to go to this one, question number 3. The Trust Computer Corporation has been experienced in the abnormal dividend. So that actually we have done it, and I don't know whether no one has involved in that. Right. I will start with another question paper now. Say right. So this paper we will discuss further after this after a break. So then you can get familiarize yourself with the question paper. Now we have already discussed some of these questions, some of the questions of this paper, and today we are going to discuss from question number 6. So make sure that you just go through it and prepare for it. Then I will start the things again by 3:45. Just come back to the session. Now, as I told you, I will start with the question number 6 as appears in the screen. So now I will go to the question number 6 of the question paper, which I put on the screen. Right. Wellness Hospital Limited will make payments for its pension fund for the next first, second, third, and fourth years at the end of each year of rupees 10 million, 15 million, 20 million, and 25 million. So, respectively. So, we can say in the first year, a payment of 10 million, in the second year, payment of 15 million, in the third year, payment of 20 million, and fourth year, payment of 25 million. So, this is the payments made to be made in next first to fourth years. So the first question, if the market yield curve is flat at 11%, calculate the macular duration of these payment liabilities. So that is the first part of the question, and it carries 8 marks. So how are we going to do it? Now, even for a liability or whatever assets, we are in a position to calculate the macular duration by getting the cash flows calculated and the present value of the cash flow multiplied with the time. And then it is to be divided by the total value. So that is how the duration is calculated. So I just give you that task now. Can you calculate the duration for these values? So now when I say, when the question says if the market yield curve is flat at 11%, the meaning is the discounting rate is 11%, or yield to maturity is 11%. So then we are in a position to calculate the macular duration. We have 10 million in the first year. So the present value would be 10 divided by 1.11. So 9.009. That is the present value of cash flows. Then 15 million. 15 million is the second year. So that means, so you have to note it down on the worksheet. And I will put a worksheet on the board. once you do the calculations, you will find that in the first year, there's a payment of 10 million. In the second year, there's a payment of 15 million. In the third year, there's a payment of 20 million, and the fourth year, 25 million. So when you do the calculations, you do the present value of the cash flow calculated. For the first year's payment, it is to be calculated 10 divided by 1.11. That comes to 9.009. Then for the second year, it is 15 or 1.11 to the power 2. That comes to 12.174. Then in the third year, 20 divided by 1.11 to the power 3. That comes to 14.624. And in the fourth year, 25 divided by 1.114. 11 to the power 4, that comes to 16.468. So these are the present values of cash flows in the 4 years, and the total of it will come to 52.275. Now with that, we are in a position to calculate the rates of each cash flow. So first year the cash flow rate is 0.172, the second year it is 0.233, third year it is 0.280, and the final year, the fourth year, it is 0.315. So altogether, the total comes to 1, and the weights are correct. Then we get the last column calculation time into 8, which comes to, in the first row you get 0.172, second row you get 0.466, third row you get 0.840, last row you get 1.260. Altogether it will be 2.738. So therefore the duration of the cash payment, so this payment liability should be 2.738 years. So that is how it is been calculated. Yeah. So how have you got it correct? This is the way the duration is calculated on the payments, wellness hospital. Where Sajipan, have you gone through that?
Yes, sir.
So anyway, now the calculations are given on the board, and you can just see it. And as it is, the duration comes to 2.738. And make sure that you do the calculations on this basis, and as a worksheet, you can put it that way. So the next part would be right. If the market yield curve is flat at 11%, calculate the maturity duration of this payment liability. So there you do the calculations and you will come to 2.738. That is the maturity duration. Then the second part comes, in order to immunize the portfolio, what percent should the wellness hospital allocate to 2-year and 4-year zero coupon bonds in their current investment? Now, this is the next part where you have to make use of what you have learned on portfolio immunization. Now, the portfolio immunization really deals with the zero-wise in portfolios plus and minus durations. So, in that case, when you have coupon bonds, so the coupon bonds are assets. So the asset duration should be equal to the liability duration. So that is the principle of this immunization method. Now you have 2-year and 4-year zero coupon bonds, where you know that 2-year bond has a duration of 2 years since it is zero coupon. 4-year bond also has a 4-year duration. So since that is also zero. So what we are now going to do is, we try to have a percentage of 2-year and 4-year bonds to match the duration of 2.738. So how can we work it out? So we assume that we have alpha percentage of 2-year bonds, and Therefore, 4-year bonds will have a percentage of 1 minus alpha. So by using that, we are in a position to calculate alpha. So then we need to have a equation. So before putting that equation, we say that we assume in the portfolio of 2-year and 4-year bonds, we have alpha percent of 2-year bonds and 1 minus alpha percent of 4-year bonds. Assume in the immunized portfolio, we have alpha percent of 2-year bonds and 1 minus alpha percent of 4-year bonds. So that for that reason we can have 2 into alpha plus 1 minus alpha into 4. It should be equal to 2.738. Now you just see. Right, as it is, when you assume in order to have a immunized portfolio, we need to equate the liability duration with asset duration. So therefore, now we have already calculated the liability duration, and that comes to 2.738. And our asset duration would be, we have 2-year bonds and 4-year bonds. We assume that we have a alpha percentage of 2-year bonds. So therefore, the duration of it should be 2 into alpha plus 1 minus alpha is the other portion, that is 4-year things. So 1 minus alpha into 4, which should be equal to 2.738. Now, in order to get the alpha calculated, you can solve this equation. So after solving the equation, you need to get the value for alpha. So that alpha value would be the percentage of 2-year bonds. So when you find alpha, then we can get the 4-year bonds percentage also. So just get the value of alpha. Yeah, 2-year 63 and 4-year 37. Yes, we will see. So this equation has to be solved and you calculate the alpha. So there you get 2 alpha plus 4 minus 4 alpha is equal to 2.738. So therefore, minus 2 alpha is equal to 2.738 minus 4. That also will be a minus figure. So that is 262. 1.262 minus 1.262. So minus 2 alpha is equal to minus 1.262. So therefore, alpha is equal to 1.262 divided by 2. That is 0.631. So we can say 0.63. So therefore, 2-year bonds we have 63%. 4-year bonds we have 37%. So that is the answer. So now for the second part of the question, the answer would be you need to have in order to immunize the portfolio, what percent should be the wellness hospital allocate to 2-year and 4-year zero coupon bonds in their current investment? So they need to in their investment they need to have 2-year bonds 63% and 4-year bonds 37%. Determine the accumulated face value of the bonds. So how are we going to do that? We have to get the face value of the bonds, accumulated face value. So we are talking about the face value. So how are we going to do it? Now the face value would be now this is a 2-year bond, and since it is 2 years, the YTM zero since it is zero coupon also, so there should be a discounting factor. So the total would be so what should be the total then? Now we are in a position to calculate the present values of the bonds. How are we going to do that? So we know that the total of present value of the cash flows would be equal to 52.275. 52.275. So with that, we can calculate the present value of the 2-year bonds and present value of the 4-year bonds. So 2-year bonds we have 63%. So therefore, the present value of the 2-year bonds would be 52.275 into 0.63. So that is the present value. So 32.93 would be the present value of 2-year bonds. 32.93. Then if you go to the 4-year bonds, there you get 37% of 52.275. 37%. There you get 19.34. So these are the present values of the bonds. Then how are we going to get the face values of those bonds? So you have to just discount it. Not discounting, really, you need to get the future value for that. The future value would be, say, for the 2-year bond, what you need to do is, you get the value and it has to be multiplied with 1 plus the rate, that is 0.11 to the power 2. That will give the face value for the 2-year bond. For the 4-year bond, there also you get the present value into 1.11 to the power 4. So you will get the final values in that way. Right. So is it clear for you? Yes. PV total is 52.275. Yes, that's correct. Then the portion of 2-year bonds would be 63. So 63% of 52.275 you can calculate. That is 39.42. Is it? Yeah. No. 39. No, present value. So present value can be calculated. Yes, 4-year things. Present value is 63% of 52.275. That is 32.93. 32.93 would be the present value of 2-year bonds. Present value of 2-year bonds. And present value of 4-year bonds would be 52.275 into 0.37. That is 19.34. But what you can do is, so you need to multiply with 1.11 to the power 4. 29.36. Yes, correct. 4-year bonds 29.36. Then two-year bonds 40.57. Yes, right. Right. The answer is correct. Then you have bonds, 2-year bonds to the face value of 40.57 and 4-year bonds to the face value of 29.36. The total of which will come to some amount. So that is close to 69, yes, 69, 70, just 70 like. Now, I think once you have already just mentioned about a certain factor you can observe here. Now, when you just look at the total of the face value, you will find that it is come very close to 70. Very close to 70. Just add it and see what is it. 7 plus 6 is 3, then 96. Yes, you get 69.96. That is very close to 70. So that is the total of all the cash flows. Now you just look at the cash flows there. The 10 million, 15 million, 20 and 25 million. If you take all the cash flows together, you get 70. I think one participant really made that observation on that particular day. So I'm happy for that. Now also you can really observe that here. Because when you talk in terms of the face value, that face value is equal to the total of cash flows. Without making into present values, if you take as it is, the face value would be equal to that. I think this is a possibility, say there will be a possibility of having this type of sum in your question paper. So make sure that you put the correct arguments in your answer. If you don't put the arguments in your answers, you might lose some of the marks. You won't get the full marks for that. So therefore, it is for your interest, you need to do those things, and you need to mention clearly the assumptions, the types of arguments, all sort of things you have to put on the paper. Yes. Right, now we will go to the question number 7. Now just look at the marks allocation also. Now you can just see the part A allocated 8 marks. Now that is the macular duration calculation, and it has some work also. So therefore, that is why the marks higher level of marks been allocated there. Right. Question number 7. The rate of return and risk for 3 stocks in the S&P 500 index were calculated over the most recent 5 years and are listed below. Now these are the stocks: the Dreamstar, Innova, and Franklin. So we can put it as DEF, whatever it is. Returns are given as 15, 13, and 12, and risk given as 16, 18, and 11. And S&P 500 returns given as 15 altogether. So because it should be the same return because it is in the same market. Assuming the 1-month T-bill rate as 7%, rank each stock according to the Sharpe performance index. So these are very, very easy type of things where I think this type of questions will give a chance to any person to get through the examination. But if you don't make use of these things, then that is your foolishness if you do that. So therefore, these questions are very, very easy actually. Now, what is Sharpe index? Sharpe index comes with risk premium divided by the risk. Risk premium divided by the risk. So first of all, you need to get that idea. Sharpe index you need to calculate for Dreamstar. So what is that? And you need to calculate the Sharpe index for Innova. You need to calculate the Franklin's index of Sharpe index. So come to that points and just look at those things and see what those answers are. Right. So what are the values for Sharpe index for Dreamstar, Innova, and Franklin? Very easy. You can just do it now. Yes, do it for. Then you need to rank it. You need to rank it. So you get the Sharpe index value for Dreamstar. What you need to do is you get the return, the premium. Premium is return minus the treasury bill rate. That is the risk premium, we call it. Then for the risk premium for Dreamstar comes as 15 minus 7, that is 8. 8% divided by 16%. So that comes as 0.5. So Dreamstar's Sharpe's index would be 0.5. Then Innova's Sharpe's index would be 13 minus 7, that is 6 divided by 18, that is 1 over 3, that is 0.33. 0.33 would be Innova's Sharpe's index. And when you go to Franklin, there you get 12 minus 7, that is 5 divided by 11. 5 divided by 11 comes to 0.45. So there you get Dreamstar Sharpe index as 0.5, Innova Sharpe index as 0.3, Franklin Sharpe index as 0.45. So then what is the ranking? You can rank the first highest ranking can be given to Dreamstar because the Dreamstar will have the highest Sharpe index. Yes, then Dreamstar would be the first number 1 rank. Number 2 rank comes to Franklin with a 0.45 of index, and the with 0.33 of index Innova comes to the last. So D, F, E would be the ranking. Right? Can you try this particular one? Both the second part also you can do. Determine the rankings according to trainer's measure. Now, in order to get the trainer's measure calculated, you need to get the beta values also. Beta values are not given, but you have information which you can make use of in order to get the beta value calculated. So just look at it and see how you can get the beta value calculated here for Dreamstar. Risk rate is also available. Yes. Just try to get the beta values calculated for Dreamstar, Innova, and Franklin. Right. Try to get the beta value for dream star. Yes. Now, in order to get the beta value calculated, you need to apply the capital asset pricing model. As per the capital asset pricing model, equilibrium return is equal to risk-free rate plus market return minus risk-free rate into beta. From that equation, you can get the beta calculated. Right. Now, just to get the beta value for dream star, yeah, you can say 15 is equal to 7 plus 15 minus 7, that is 8 into beta. So 8 into beta is equal to 15 minus 7, that is 8. So beta is equal to 1. For dream star, beta value comes to 1. Just find out beta for others, Innova and Franklin. Now this dream star, what is the value? It is the beta value for dream star? I don't know, 0.88. Just see. Now there the values would be Dream star, the beta value is 1. That's correct. Beta value is 1 for dream star. Innova, what is the beta value? 1.15. Just see. Yeah. Innova, 13 equals to 7 plus 15 minus 7 is 8. 8 beta. So 13 equal to 7 plus 8 beta. 13 minus 7 is 6. Then 6 is equal to 8 beta. 6 divided by 8 would be the Innova's beta. Just see. Nova's beta is 1.1. Now Innova's return is 13%, so 13% is equal to 7% plus 15 minus 7 into beta. So you get 6 divided by 8. So therefore it should not be 1.1 something, but it should be a figure which is less than 1. Thirteen minus 7 would be 6. 6 divided by 8 is 3 over 4, that is 0.75. 0.75 would be Innova's beta. Innova's beta would be 0.75. Yeah, Innova's beta would be 0.75. Franklin's beta would be now Franklin's return is 12%, so therefore 12 minus 7 would be 5%. 5 divided by 8. 5 divided by 8 would be 0.6 something. Yes. 0.625, yes. Franklin beta would be 0.625. Correct. Now you know the betas of Dreamstar, Innova and Franklin. Dreamstar's beta is 1. Innova's beta is 0.75. The last one, that is Franklin's beta is 0.625. So with that, you are in a position to calculate the trainer measures for these three. So this, just calculate the trainer measures for these three: Dreamstar, Innova, and Franklin. Now in this sum, the allocated marks would is higher for part B because it involves some work, more work, because there you have to calculate the beta, and that beta has to be utilized in order to get the measures calculated, trainer measure calculated. Now you need to have an idea about the paper and some confidence. You need to build up some confidence with regard to the answering of question paper. Now you need to just find out whether the rankings according to the Sharpe's and Trenner's measures are different or same. The ranking order is same. That is also another. Now, when you want to do the comment on both rankings, now it involves that. So what is this? All got 8. Yeah, you mean the premium. No, there's no. Why do you say all rankings according to trainer measure performance, Asi? No, when you say the ranking, the trainer performance measure, when you do, you calculate the trainer performance measure. There you get all got 8. That's I don't know. I will just check. Yeah. Beta is yeah. Trainer performance measure 15 minus 7, that is 8. 8 divided by Dreamstar's, yeah, Dreamstar is 1, so therefore it is 8. Innova is also 13, 6 divided by 6. Yeah. Ranking 12 minus 7 divided by 8. Yeah. So that means all are in the same rank. All are in the same rank. Yes. Right. Now when you do comments on these things, you have to just tell these things, and as per the trainer measure, all are in the same level. All are in the same level, but as per the Sharpe's measure, these can be ranking to the order of Dreamstar, Franklin, and Innova. So only thing is, now when you deal with risky type of assets, the market stocks or whatever, then the trainer measure would be a more realistic measure for such things. So that you can mention. That you can mention. Right. Now we will go to the question number 8. Do you have any type of issue in the last question?
Sir, how to comment comment about rank suitability?
Comment actually now what we can do is now there's a special type of phenomenon here. Now as it is the rankings when you go by the trainers measure, all are in the same level of performance. So therefore they are at the same rank same. All are rank same. So that is a specific thing comes here. So therefore you have to comment on that. So then you can say the ranking doesn't give any demarcation with regard to the trainer's performance measure. Then if we need to do a selection out of these things, you can see the other ranking, that is Sharpe's ranking. As for the Sharpe's ranking, you get the Dream Star at the first one. And the second one as Franklin, and third one as Innova. So therefore, if you need to do a selection out of these three, then you have to go by the Sharpe's index for your selection purposes only, because if you go through trainer's measure, there's no way of selecting because all comes in the same rank. So that is one use of these two measures. So the suitability, if you go by the suitability comes only with now for these type of stocks. Now stocks means all are risky assets. But if you go to another type of asset, just like treasury bond or corporate bond or whatever, fixed income security, so there the ranking is normally done through Sharpe's performance index. So that you have to write as a comment. But in this particular special case, you have to see now, if you don't have a Sharpe performance measure here, we are not in a position to select one of these stocks or identify any basis for selection. So therefore, in this particular situation, Sharpe performance index has just fulfill some type of help in hand here, because otherwise now the person who is going to select one of these stocks will have no idea, because it comes all are coming in the same rank. So therefore, in this particular case, Sharpe's performance index served the purpose. So that's type of a comment you can make. Right. Shall we go to the next question? Question number 8. Right. It is future investment values question. So dealers in the bank ABC plan to invest ₹1,000 million in a fund indexed with the FTSE 100. So FTSE 100 is a stock index, and this particular investment is going to be made in a fund which is indexed with FTSE 100. The continuous return and the continuous standard deviation of the FTSE 100 index has been 15% and 18% respectively for the last 50 years. Now, they did a calculation and they did some observations with regard to the past history. And they found that for the past 50 years or last 50 years, the funds or FTSE's index return and the standard deviation had recorded average value of 15 and 18 respectively. So part A of the question, what is the probability of doubling the investment in 10 years by ABC Bank? Now you got the formula, and in the formula you know, if V refers to the future value, V refers to the beginning value, RC refers to the return, continuous return, and N refers to the number of years, future years. And sigma refers to the standard deviation. So that, of course, you need to understand, and never in a question the things been explained, because just to say that all these things are coming under standard form. So therefore, a person who answers the question paper should know what these symbols are for. Right. So first of all, then what is the probability of doubling the investment in 10 years by ABC Bank? Now here what we do is we just try to find out result for that. Now just look at it and see what are the values which we need to put there. Now when you say doubling the investment means, what is your investment now? 1000 million. So therefore when you say doubling the investment, the future value will become 2000. So therefore log 2000 divided by 1000 will come as log 2. That is the first value for that, log 2 minus RC is equal to 15%. So therefore it is 15.15 into 10. N is 10 into, divided by sigma is 0.18. It has to be multiplied with square root of 10. So when you calculate that, the Z value comes. Just to get the Z value, how are you going to take the Z value? Yes. You just calculate the Z value and tell me. Minus 1.417. Got it. Minus 1.417. Yes. Now, in order to look at the normal curve tables, this is this you get a minus value. Why is it? Is equal to minus 1.4176. Right. So better if you can get it for 2 decimals only. Otherwise, it's too difficult for you to get a value. It should be minus 1.42. So then you have your normal curve tables. So then just go to the normal curve tables and get the value for that. Yes, 1.42 it would be. Minus 1.42. What is the value there? 0.0778, correct. 0.0778. Now, this is the now you start with the minus value, so therefore the probability comes the other side. Now, to have a success, the probability would be what? It is not 0.0778, it is 1 minus 0.0778. So therefore, you have a probability of 92 point something. The probability is that. So you have to argue and just get the answer that way. Because this particular probability comes to the left of the value. So that is the unsuccessful thing. So therefore 92.20 would be the answer. That is the probability of having a success. Correct. So having that probability is a rather positive thing, because 92% probability means now it might happen. Might happen. Right. Now shall we go to the second part of it? Right. Then next one would be the determine the probability of incurring losses within 10 years from this portfolio. Incurring losses. Yeah. Now in order to do that, what are we going to do? Incurring losses means the point at which the future value becomes same as the beginning value. So if you have that type of situation, from there onwards you are losing. So then the limiting requirement is to have same future value as beginning value. If that is the case, there will be a value for log 1. Log 1 would be 0. And do the calculation and get Z value for that. Yes. .474. What is the value of Z? Now the log value comes to 0. Log value comes to 0. Now here log FV over B becomes 1. Log 1 becomes 0. Then you get minus RCN. RC is 0.15. 0.15 into 10. That is minus 1.5. So in the numerator you get minus 1.5. Minus 1.5 you get on the numerator. It is to be divided by sigma s, that is 0.18 into square root of n, that is square root of 10. Yes, get minus 2.63. So, yeah, 2.635. Yes. So in that case, it would be minus 2.64. Minus 2.64. Yes. I think you might have made a mistake somewhere in the calculations. So make sure that you don't make mistakes. With the familiarity, you can really avoid making mistakes. Right. Now you need to just get the normal curve table and get the probability value. Minus 2.64 minus 2.64. Yeah. Comes to 0041. 0041. Now what should be the answer? What should be the answer? Now here the requirement is to get the probability of having a loss. So then how do you put it? 0.0. Now when you just get the value for minus 2.64, it comes as 0.0044, right? Not 41. Sorry, 2.64, right? Okay, 2.64. If it is 2.64, it is 0.0041. It is not equal to 41%. This is the probability of having a loss. It is not 41%. Now, this is 41% only if you have 0.41. 0.41 is equivalent to 41%, but this is not equal to 41%. This is 0.41%. There's a very, very small probability of having a loss. Very small probability. 0.41%. That is correct. 0.41% is the correct answer. Now, I think you can appreciate that answer because it seems that having a loss would be a very, very low probability. Very low probability. So you can say that having a profit will have a high probability, that is 99 point something. 99 point something probable to have a profit. Having a loss will have a probability of only 0.41%. So that is the beauty of that. Yes. Okay, I think that's a very interesting question. And I think the next part has been allocated a high level of marks. Now you can see the calculations carry only a small amount of marks, say comparatively low amount of marks, but here it allocates 8 marks here. Please give comments on the applicability of the model in the given scenario. So how are we going to answer this? Now, in my notes, I have given some of the assumptions in this particular case. Now, as per the assumptions, the data was really extracted through certain observations in last 50 years. That's a considerable period of time. So in that period, if the continuous return and continuous standard deviation as those values. And then what is the next assumption? These trends will prevail for the next couple of years or next 10 years or so, this will prevail. So that is one assumption. And the other thing is, the analysts think that this fund is really indexed to a FTSE 100, and we think that the fund, this particular fund also will behave parallel to the FTSE 100. That's another assumption. So therefore, the model can be used only with those assumptions. So that is what you have to write here as comments. The applicability really depends on the possibility of making the assumptions. If the assumptions are not really not realistic or not probable, then the model may not be valid for these calculations. So if a person doesn't make the comments on this in this manner, that person may lose the 8 marks. Then these people would get only 12 marks or 10 marks or so. Therefore, we should not lose marks by giving some missing comments. So therefore, you have to be careful when you make comments on these questions.
Sir, can you repeat the comments again?
Yeah. So first thing is, now, since the analyst making the information, what the analyst did was the particular person had done an observation for, say, last 50 years, and they just found out the trend in the last 50 years, and they have an assumption that this trend will prevail for another considerable period of time. And they have taken 10 years, and 10 years will be the number of years or which will prevail, which the trend will prevail. So that is one assumption, right? The second assumption is the particular fund, it is indexed with the FTSE 100, and it goes parallel with FTSE 100. So that is the other assumption. Now, without these both assumptions, you are not in a position to apply the model here. The application of the model solely depends on the assumptions. So these are the two assumptions. And the other thing is the particular distribution, the profit distribution is log normal. That is the other assumption. So all these three assumptions to be given in context as the comments. Right. I think I have given these things in the notes. Huh? So you should be very particular about the notes and just go through the notes and get it done that correctly. So then make sure that you get full marks for this particular question. Now I think you really appreciate the particular answer, because earlier times what we did was we just get the probability by deducting the particular value from 1. But in this case, we are going to get the possibility of having losses, no? So therefore, we just get the probability as it is. So that is also a factor to be considered, right? I think up to question 5 we did last time. Now today also we just did some other questions from other question papers. Yeah. This is the one we just studied earlier. Right. Now, here the question number 8, that is the same as the earlier one. I don't think that it's necessary to have that calculated now. Now, I think you need to be careful about this duration, convexity, and such type of things. And now, in most cases, if even I have given it in the within the brackets, assume that the yields are continuously compounded. So that's another factor you need to be careful about. A 4-year bond with a yield of 10% per annum pays 6 per annum coupon at the end of each year. Now, I told once I told you that if it is otherwise, if it doesn't mention otherwise, so you need to get it as semi-annual payment. But if a particular sum, if they say that it is annual coupon, per annum coupon at the end of each year, means that is annual. So therefore, you need to take it as annual. I think you might not get misled by the things. By reading the question well, you will be in a position to get the correct idea. Now, in this particular one, how are we going to find out the duration? So, since it is a 4-year bond, then you might get coupon payments per annum, and assume the bond value as 1,000 or 100, whatever. I think better if you can assume it as 1,000 face value. So if it is 1,000, the coupon would be 60 per annum. So yield is 10%. Since the yield is 10%, you can say, you can just calculate the present values of all these cash flows. Now, when the present values are calculated, you have to be careful. It is not the normal way. You need to do by exponential calculations, so e to the power. For example, at the end of the year 1, you might get 60 into e to the power minus 0.1. So then no, e to the power minus 0.1. So that is the year 1, first year, end of the first year's cash flow. Present value of end of first year's cash flow would be that 60 into e to the power minus 0.1. To the power minus 0.1 into 1. Then when you go to the next year, the present value, there you get 60 into e to the power minus 2 into 0.1, that is minus 0.2. In the third year, you get 60 into e to the power minus 3 into 0.1, that is 0.3, minus 0.3. So in the fourth year, you get 60 into e to the power minus 0.1 into 4, that is 0.4. So by doing that, the last year, in the last year, you will get 1060, not 60, 1060, because the bonds proceeds also will come at the last year. And it should be 1080 into e to the power minus 0.4. Now, when you do the calculations, the cash flows are there, and at the same time, you will have to get the weights calculated, and weight into the time will give the duration. And what is the convexity? Weight into the time squared will give the convexity. Right, we will just see what it is now. I think the part A is a theory, so you can just go through the notes and find it out. But I think we can work out the things here. Now in the working out, what you should do is, you have 4-year cash flows 1, 2, 3, and 4. Then your cash flow would be 60, and 4th year cash flow would be 1060, but present value would be 60 into e to the power minus 0.1. In the 2nd year, it is 60 into e to the power minus 0.2. Likewise, you get all the cash flows, and you just do the calculation and get the total value, total present value, and get the weights. So that is one part of it. Then the last part would be the weight into the time factor, where you get the total as the duration. So have we run it? I think you could have done it. Can you repeat me? What do you what you need me to repeat? The assumptions. I have assumptions. Assumptions in the sense, now in this future value model, there you assume the particular analyst has gone through historical data for a considerable history. So the assumption would be the same trend will prevail for another considerable period of time. That is number one. Number two is, they talk about index fund, FTSE index fund, and that fund really go parallel with the FTSE index. That's the second assumption. The third assumption will be the profit and that return distribution is distributed in a log normal curve. So these are the 3 assumptions which we need to clarify when this model is used. I think you can have a better idea by going through the notes again. Then you will get it clearly, right? And what I want to tell you is this particular subject area, it has some research components where the chartered financial analyst, I don't know whether you have heard about them. I think you come across people who got that examination, got through, CFA people. So that institute has done the research on this. Right? They have made research papers on this. So I think this is a very important type of factor here. Right? I think I really appreciate your consideration or your concern on these assumptions, and you can be better equipped by again going through the notes, so you can get it clearly done, clearly established in your mind. Right? If anyone needs to get more details on that, so let me know. So you can just give me a call and ask me any additional information on that. Right. Now, have you done this duration thing? Now, to find out the duration, you need to have that worksheet together with the calculations. And even the convexity can be calculated in that manner. Now, I'm just asking you a question with regard to the question number 6. Now, it is specifically said that you need to do the calculations on continuous compounded basis. Shall we do that now? Because you can just match your answers and see that whether you have done it correctly. Right, of course, now we can just make the worksheet. Now it's like this. Now you have duration. You need to get the duration. So it talks about 4 years. And the yield to maturity is 10%. Coupon is 6%. So then we assume here the great thing is now they have not given the face value of the bond. So if it is the situation, so you can assume a face value. Either 100 or 1000. I think better to assume 1000 rather than 100. So therefore, if it is 1000, the coupon amount would be 60 per annum. So you will get 4 cash flows at the each year end. First year end you get 60, second year end also you get 60, third year end also you get 60, and fourth year end you get 1060 together with the proceeds of the bond. Now our next task is to get the present values calculated on continuously compounded basis. So our first cash flow would be 60. In order to get the present value calculated, what you can do is we have to multiply it with e to the power minus 1 into 0.1, because it comes as e to the power minus nr. N is the number of years, r is the annual rate. So e to the power minus 1 into 0.1. So then e to the power minus 1.1. Right? So when you go to the second cash flow, that is at the end of the second year, the cash flow would be again 60, and present value would be 60 into e to the power minus 0.2. In the third year, you get 60 into e to the power minus 0.3. In the fourth year, you get 1060 into e to the power minus 0.4. So now you can find out all these amounts, right? So what are these amounts? First year it is 0.1 P. Into 60. That comes to 54.2902. That is in the first year. In the second year, it would be 60 into, sorry, e to the power minus 0.2 into 60. That is 49.1238. In the third year, e to the power minus 0.3 into 60. That comes to 44.449. In the last year, that is fourth year, e to the power minus 0.4 into 1060. That is 710.539. Now, what you now need to do is you need to total up, and you can get the total present value. And after getting the total present value, you can calculate the weights. Now, you need to have a column for the weights, and that weight column and the time column can be multiplied. And you get another column called time into weight. The total of that column will give you the duration. Now, in order to get the convexity calculated, what are you going to do? Now you need to have another column constructed, and we call that column time squared column. Then you have a time squared into weight column again, the total of which will give you the convexity. I don't know whether you have done it. So if you do it, then it is a good practice for you. Otherwise, in the examination, you might total PV is 858.40. That's the case, yes. 54.29, 49.12, 44.45, yes, correct. It will be yes. And then you can calculate the weights also. The first year, the weight would be the 54.29 divided by 8.4. Then the second year, 49.12 divided by 85840. So likewise, you can calculate the weights, right? Yes, 0.063, 0.057, 0.051, 0.827. Now we can add it up and see whether it comes to 1. 3 plus 7 is 10, 10 plus 1 is 11, 11 plus 7 is 8. So you can just put 2 here and 1 here, 8 to 8 and 2 here. So if that is the case, then you can have it as, so that type of a gimmick you have to make. So because now since you do rounding off here, you might lose 1 or 2 decimals. Because of that, the total doesn't come as 1. But what you can do is you can make a small adjustment somewhere to get it as 1. So here you can put 0.52 or something, and somewhere else you can have it as 8. So then you need to have it as 1, the total, right? Okay, it's okay. Now then what you have to do is the time and weight has to be multiplied, and there could be another column for that. The total of that column will give you the duration. I will just do it. So if it is 0.063, the 1 into 0.063 plus 2 into 0.057 plus 3 into 0.051 plus 4 into 0.827. Answer is 3.638. So this is the duration, right? So then again, we can calculate the convexity also. Only difference is you need to multiply the weights with not the time squared. So the first one would be 1 into 0.063, the same. Then it is 0.063 plus, then you have to multiply There are other way with not 2, with 4. 4 into 0.057. Then in the third one, it is number 3. Time is 3 and time squared is 9. 9 into 0.051. Then you have a last one, that is 4. The square of 4 is 16. 16 into 0.827. Altogether, it is 14.034. That is the convexity. You got duration as 3 point something. Convexity as 14 point something. Now we calculated the duration as well the convexity. So therefore, now we are in a position to get sensitivity calculated by, say, when interest rates change in the market, what would be the change in the price that we can do. And I just refer the note here, and in the note I have given you a particular formula where you can say delta P is equal. What do you mean by delta P? The change in price is equal to minus D into delta Y. Delta Y is the change in yield into the price P plus half into C. C is the convexity into delta Y square, the change of yield square into P. And that will give the change in price. Because specifically this formula has to be used when the interest rate change is higher. The higher means if the interest rate change is higher than 1.5%, or in other words 150 basis points, this particular formula has to be used. Now, since the formula has to be used, you have to memorize that formula also. What is that formula? Delta P is equal to minus D into delta Y plus delta Y into P plus half into C into delta Y squared into P. So this particular relationship or the equation you need to keep in mind, keep in your mind. So since if you find a particular interest rate given in the question as a substantial interest rate change, then invariably you have to use that formula. Otherwise, if the interest rate change is small, so it is less than 150 basis points, then you can use delta P is equal to minus D into delta Y into P. That's all. And I just explained to you why we have to use that approximations here. Right. If you want to clarify anything on this, that also you can just ask me, because now we are coming close to the examination. So therefore, I think you need to get all these things clarified. Otherwise, you might get confused in the examination, and that should not be a good thing. So therefore, you have to be clear about all these things. So I think today, I think we are not in a position to go further. And there's yet another subject area, and I wanted to do it with all these calculations, after all these calculations. So we will start with that in the next week. That is the term structure of interest rates. That is the next lesson. I think that lesson will have a rather important aspect. So therefore, I think you all will closely follow that. So therefore, till we meet again on that particular lesson, I just wind off the session. Thank you very much for your active participation in the sessions. And I really request you to participate in even future lessons very actively. Thank you very much.